Hi, it's Mike Power with Silver Range, and this is a midsummer look at what we think of junior mining exploration markets and an overview of some plans ahead for Silver Range. First, a quick word from our lawyers. As a prospect generator, markets matter a lot to us. It's tough to raise money, and we have to deploy capital skillfully, and particularly with regard to timing. So we really like to know what's going on in the market, and I'm sure you as investors do too. So let's have a look at how we see things here. We're going to look at financing activity, which is a concurrent indicator of market health. And then let's have a look at markets because they're our best indicator of what's about to happen in the future. We'll have a look at option activity, what promoters think is going to be hot and not. And finally, we'll take a look ahead for Silver Range. We track mine financings on a daily basis, taking our data from CDAR, using data kindly provided by John Kaiser going back to 2002. This is TSX Venture financing data. We've been able to calibrate our data with his to develop some thresholds for assessing the relative health of the financing industry, particularly in regard to three indices we find most useful in assessing the health of mine financing. Total financings are our first indicator of overall financing health. And over the last 6 months, semi-monthly financings have averaged about 524 million every 2 weeks, or semi-monthly. This is a very healthy level. It's at the upper end of our okay level, approaching levels we'd expect to see in a hot market. So big thumbs up on total financing. However, if we look at the financings less than 2 million, and these are the financings companies need to keep the lights on and do small programs, we find that things aren't looking quite so good. Semi-monthly financings over the last 6 months have averaged about $32 million on a semi-monthly basis, and this is well into slump territory. So this is this tale of bimodal markets. The guys at the bottom are having a tough time raising the financings they need to keep going and perhaps become one of the stars. Guys at the top are finding that money is a lot more readily available. Finally, our third financing health indicator is the proportion of financings less than $200,000. Now, in tough times, companies can only raise money in small amounts just to keep the lights on, and the proportion of these very small financings increases dramatically. When times are good, they drop below about 15%. That's the horizontal line you see in this graph here. Now, currently, on a semi-monthly basis, the proportion of small financing since the beginning of the year is averaging about 28%, and that's in the slump territory. The good news is the trend seems to be improving, and that perhaps we'll be out of the weeds here before the end of the year. So not a positive sign, but on the other hand, the trend is looking favorable. Let's turn to markets. While financings provide the oxygen for our business, markets drive financings and are our best indicator of what's in store ahead. Let's start with the ugly. Here's the CSE composite since the last market cycle started in April 2020. You know, if you walked into a hospital and you saw a chart like this behind your old Aunt Edna's bed, you'd probably despair. There's really not a lot of good news here. Now, half of the CSE composite index is mining stocks, so this is a pretty good indicator of the health of junior mining at the very bottom end of the market. But if we look to the venture, it's a different story. The venture has turned. It turned just after Donald Trump's Liberation Day in April, although you could say really what happened there is it just inflected upwards. Now, half of the venture exchange is mining stocks, and mining has basically lifted the venture exchange in the last 6 months. There's almost 30% growth in the TSXV mining index, and I think that's doing a lot to help the TSXV overall. Now, if we had to look at this, I think you would agree with me that everything turned here in about November of 2023. That was the bottom end of this last cycle, and that's when it broke trend. There's a similar picture if we look over Australia way. Here's the S&P All Ordinaries Gold. This would be equivalent, I think, of our TSXV, but it's just junior gold companies. And this too hit bottom, but it did about a year earlier than the venture, interestingly, in about October of 2022. But you can see here, clearly broke trend, and it's been on the up and up since then. So we have a tale of two markets. The juniors at the bottom are suffering, and some of the better companies are doing quite well. To put this all in context, let's have a look at what I like to call the junior mining greed disgust cycle. Looking back over data into the 1970s, I find repeated market cycles that are generally characterized by something that looks a little like this one. This is the 2016 through 2020 cycle. Just prior to the market bottom, there's no interest in junior mining stocks, and the prices decline, sometimes precipitously, and interestingly enough, volume also declines, often approaching a low shortly before there's an actual market bottom. When the market finally hits bottom, that's when a new greed disgust cycle starts. And here's what fooled me on this one. Normally they start with a very sharp turnaround, a lot of volume, and a large increase in the market index. So often there's a very quick rise, and we enter a period of euphoria. The retail investors are back. It's easy to finance. Financing tends to peak earlier in this cycle, somewhere around here. And then the market gets stale and wanes, and people head for the exits, and we're back to the tail end waning stages of the market, and the whole thing eventually repeats itself. Now, the thing that fooled me on this last market cycle was I didn't see a sharp increase in volume or in the index or in financings. But it's very clear when looking at the data in the rearview mirror that the market has turned. So this is what things looked like last March when we last did this update, and I wasn't quite sure how much longer this cycle was going to go and whether there might not be another sharp capitulation trough ahead. But looking at it now, I'm feeling very confident that the capitulation trough was a very small one. It occurred in November 2023, closing off one of in fact, the shortest cycle in the data I have, and beginning a brand new greed disgust cycle that is just starting to take off. Now, this is different than the other cycles because, as I said, there wasn't a sharp increase in the market index, in volume, or in financings. But there is an analogy, and it was brought to my attention actually by a very experienced broker who phoned me up this spring and said, I think the market has turned. Now, I looked at my data at the time and I said, I don't see it. But he says, no, I think it's turned. This feels like my recollection of the early 2000s. And there are a lot of similarities. There was a volume trough followed by the capitulation trough in the market index, and then things slowly improved over the course of almost a year. I think the same thing has happened here. We had a volume trough in the summer of 2023, and the index finally bottomed in November 2023, but it's been on the rise ever since, and volume is definitely picking up, albeit not to the levels we saw during the COVID rush. So I think that I can safely conclude that we are definitely in the beginnings of another greed disgust cycle, and things are going to get better sooner rather than later. Let's turn to option activity and see what the promoters are up to. Surely they can sense a market turning and smell blood in the water. Well, here's overall option activity since 2012 on a monthly basis. The solid line's the moving average. It's probably the one to look at. There's a lot of noise in this graph, and to help make sense of it, I've highlighted periods of market booms or euphoria in blue, including the end of the commodity super cycle in 2012, the 2016 boomlet, and the COVID boomlet. Also highlighted in green a weird bout of option activity connected with green battery critical metals in the winter of 2023. Since that last boomlet, the option activity has generally been on the decline. And here's that same data in a shorter time scale, and we've broken it down by commodities here. Once again, since February, March 2023, things have been generally on the decline and somewhat subdued. And if we look at the proportion of options by commodity, we see continuation of trends that have been developing over the last couple of years. Less and less green critical battery metal options, increasing precious metal options. That's the dominant trend I see in this data. And now and then, interest in uranium. Okay, so what's next? Well, as I said, we're at the beginning of a new cycle. I'm pretty confident now there's no big correction in store, and that we can look forward to better days ahead. There might be a broad market correction and a few other things that pull the market down briefly, but I think momentum is on the side of greed and a new cycle has begun. However, there are very poor conditions at the lower end of the financing market, and they're likely to persist through the fall. I do see improvement starting, perhaps as early as January or PDAC next year. In the interim, I see subdued auction activity, mostly in precious metals, but that could turn around rapidly if promoters smell an improving market and easier financing conditions at the bottom end of the market. What does this mean for Silver Range? Well, it is time to deploy some capital. We need to get out and move some of our projects down the pipeline up to drill-ready status. Some geophysics, geochemistry, geology, maybe some shallow drilling. We need to get them ready to move. And we need some new projects. This is the time to bulk up in anticipation of a much better option market before too much longer. So that's it. We're cashed up and we're on the move. I hope you'll ride with us. Thanks.